Hi, I'm Ilan Morgenstern, and today I'm going to talk about my paper called Data Tracking Under Competition, which is joint work with my advisors, Kostas, Bimpikis, and Daniela Saban. So let me hear two examples of some novel ways in which some companies are using data. On one hand, we have Amazon, who a few years ago acquired Whole Foods. And some analysts believe that one of the reasons that drove these acquisitions was Amazon's incentive to better understand how consumers shop for groceries by looking at Whole Foods data. On the other hand, General Motors has recently started to implement personalized insurance prices, which they can set based on consumers' individual driving histories. Now, these interactions between data across markets are important in a world where privacy has become a main concern for regulation, as we have recently seen in Europe and in California in particular. And because of this, companies like Apple and Google have recently started to advertise privacy as a feature of their product due to the consumers' increased awareness of this. So let me describe our setting broadly based on the examples I provided. So we're going to look at settings where firms may use data from one product or that derives from the interactions of one product to infer preferences or learn something about other products. In particular, we look at settings where consumer data may be used to personalize future interactions. Some examples of this are the car insurance industry, as I described, where modern cars are connected to the internet and they produce individual drivers data that insurance companies can then use to set personalized prices. Another example is the financial industry, where when customers apply for loans, they generate data that banks can then use to offer personalized credit cards. And the third example is Whole Foods and Amazon, which I mentioned. Nowadays, when the customers go shop at Whole Foods, they have the option of scanning their smartphone when they pay, if they are in Amazon Prime, to get some discount. When the consumer scans the code, Amazon is able to link their transaction at Whole Foods with their purchase history in Amazon, giving Amazon a broader picture of the consumer's purchase habits. We're going to call this structure where data from one product is used for later personalization data tracking. Now, our research question in the framework are just trying to understand what are the implications of data tracking for firms and consumers. And our focus is going to be in understanding how these implications depend on two factors. One is the presence of competition in the market, and second is the degree of consumers' awareness of firms' data tracking abilities. And what do I mean by this? I mean that it's very different to live in a world where consumers, when they buy one product, they just think what happens in that moment and don't incorporate the future costs of possibly revealing data to firms in their decisions. That is one scenario. And the other scenario is to have forward-looking consumers that develop these privacy concerns because they understand that their one transaction may give away too much data to firms in the future. The main message, I will go over my main results later, but that the argument is nuanced, and it is important to consider how these two factors interplay when we evaluate the implications of data tracking in markets. Okay, let me introduce the model. So we're going to look at a setting where we have two firms, which we call A and B, no production costs. And there are two products, 1 and 2. The structure is going to be such that both firms compete to sell product 1, but then firm B is the only firm that sells product 2. Going back to our previous example, you can think of product 1 as cars, and then product 2 as car insurance. We're going to assume horizontal differentiation in the market for product 1, which we do by using a hoteling framework. Now let me introduce consumers. Consumers types are going to be two-dimensional. We know these dimensions by S and theta, and we assume that they are uniformly distributed in 0, 1. The type S gives us the consumer's location in the hoteling line for product 1. So consumers with small values of S are relatively more likely to buy from firm A. On the other hand, the type theta gives us the consumer's valuation for product 2. And we scale this by a parameter, which we call M, which we interpret as the relative value of information. And we will see why this interpretation makes sense later. But for now, just remember that the valuation for product 2 for a consumer is theta times M. Let me talk about the timeline. So the game starts when the consumer is born and her type is drawn, and the consumer observes her type. Then firms, without knowing the consumer's type, set prices for product 1. Based on these prices, the consumer chooses whether to buy product 1 from either firm. And then in the second period, firm B sets the price for product 2. Remember that firm B is the only firm selling product 2. And then the consumer observes this price and decides whether to buy the product or not. Okay. This is our general timeline. Now, we introduce data tracking by linking these 2 periods as follows. When data tracking is present, we assume that firm B observes the consumer's types after selling product 1 to the consumer. What do I mean by this? That if the consumer comes and buys product 1 from firm B, we are assuming that firm B has enough information to learn their type in the second period. On the other hand, the scenario with no data tracking, there is simply no information flow going from one transaction to the next. And we also consider 2 scenarios depending on the consumer's degree of awareness of data tracking. On one hand, we consider myopic consumers that when buying product 1, only consider the prices of product 1 to make that decision and not incorporate the future trade-offs of giving away their information to firm B in their decision. In contrast, forward-looking consumers do consider this trade-off, and when when making their product 1 purchase decision, they incorporate the future implications of product 2 pricing in that decision. Okay, and the rest of the talk is comparing the equilibrium in these scenarios and making, trying to see what insights can we get by these comparisons. Importantly, now here I have 4 scenarios by these combinations, but we will only have 3 that matter, because when there is no data tracking, it's easy to see that whether you have myopic or forward-looking consumer doesn't make any difference. So we have 3 scenarios without data tracking, and then with data tracking, we look at whether consumers are myopic or forward-looking. Let me discuss some of the assumptions on the model. First, we're looking at a setting where data tracking is only used for pricing, which you may think it's a negative use of data, because indeed, in other cases, by learning, firms may be able to customize their product more to consumers or to make better recommendations. Here, we are not considering this personalization. We're assuming that data tracking is only used for pricing purposes. And second, we're assuming that firm B is able to infer the consumer's type after a transaction. This is a strong assumption that we make for tractability and because it captures the trade-offs we want in a clean way. But in the paper, we relax this assumption and introduce imperfect data tracking ability and find that similar insights to the one I will discuss hold. Another important assumption to discuss is that we look at a setting where data has no inherent value. Consumers may choose to avoid revealing their information only due to future economic losses or consequences. In other settings, consumers may have intrinsic privacy concerns, but this is not something that we're looking at in this paper. Okay. Here's a bit of the related literature. I will not go in the details by the sake of time, but I'll just leave it here in case someone wants to pause. Okay. Now let me discuss what are the implications of data tracking for consumers in our model. And to do that, first let me describe the equilibrium outcomes in our different scenarios. Okay, so let me first describe what happens when there is no data tracking. Okay, so what happens in the market for product 1? It's a very simple game. It's a simple hoteling game, and we have the traditional outcome in that setting. Both firms set the same price for product 1, and the market is split 50-50, with the consumers that have locations closer to firm A buying from firm A and vice versa for firm B. This is illustrated in the square here. Okay, what happens in the market for product 2? Well, since there is simply no linkage between markets, there is no information flowing from one period to the next. And then firm 2 simply sets its price for product 2 based on the available prior information. Since we assume that valuations were uniformly distributed, this price will be M over 2. Okay. And the consumers are split as in the picture here. Consumers with high valuations for data, and higher values of data higher than 1/2 buy product 2. The other ones do not buy product 2. It's a very simple outcome. Now, how does data tracking change this? In the market for product 1, when data tracking is in the model, we find that firms set lower prices for product 1. Why does it happen? Because firm B now has an incentive to attract more customers to buy from it in the first period in order to learn their information and be able to use it in the future. This creates an incentive for firm B to offer a discount. Now, firm A doesn't have this incentive to offer a discount because it doesn't collect any data, but still, due to the increased competitive pressure by firm B, it also lowers the price. However, we find that there is price dispersion. Firm B's price is lower than firm A. We get the shape, the consumer type space is split according to the shape, and I will explain why we have this slanted shape here in a bit. Now, what happens in the market for product 2? Okay, so first, the consumers that bought product 1 from firm B, due to our assumptions, have now revealed their type to firm B, who can now use this information to offer a personalized price for product 2, which is equal to the consumer's valuation. And in equilibrium, they buy this product. So all the consumers in this segment here buy product 2, but receive no surplus as they are offered a personalized price equal to their valuation. Now, what happens with the consumers below this line? So first, let's think about a consumer that is located here in this red dot. So if the consumer did not contemplate the implications of data tracking, maybe it would prefer to buy from firm B because of the lower price. However, as the consumer now anticipates some loss of utility in the second period by revealing her type, this consumer is willing to buy from firm A, even if it's at the higher price, in order to avoid revealing her type. And this is why we get this kind of piecewise linear form of the frontier that divides consumers in the model. Okay, so with this in mind, note that the firm B will now know that the consumers that are more likely, that are choosing to buy from firm A, have relatively higher values of theta. So in the second period, this is captured by offering a price that is higher than M/2, the corresponding price in the benchmark. Again, the consumers with higher values of theta than this threshold theta star will buy from firm B, and those with lower values will not. Okay. What happens with consumer surplus? So we find that if consumers are forward-looking, data tracking may increase consumer surplus compared to the setting with no data tracking. Why is this happening? Because firm B's incentive to lower prices, so consumers are benefiting a lot from the price discount in the first period, and not all consumers are having a loss in the second period associated to the personalized pricing. We find in our model that these trade-offs are such that it can go in favor of consumers, and therefore we interpret this by saying that regulation that blocks or removes data tracking could in fact reduce consumer surplus if consumers are forward-looking. Now you may think, well, assuming that consumers are forward-looking is quite strong, not all consumers have these privacy concerns, and not all of them are rational enough to look into the future. So what happens if consumers are myopic? We find that even with myopic consumers, data tracking can be beneficial for consumer surplus, although at a lesser extent than if they were forward-looking consumers. The trade-offs that drive this result are similar. Firms B incentive to lower prices for product 1, produce a benefit that overcomes the losses due to personalized pricing in product 2. However, a very important caveat here is that competition is essential to get this result. Here we have firm A that does not collect data competing versus firm B, and this creates some competition that makes the price discount to be large enough so that we have this trade-off. However, if firm B were a monopoly in both markets, we find that consumer surplus would be lower with data tracking if we had myopic consumer. So the main message here is that not only the degree of awareness of consumers about firms' data tracking ability is important to consider, but also the competitive structure of the market can determine whether data tracking can be beneficial or not for consumers. Okay, let me discuss the implications for firms. So for firm B, we find actually that data tracking is profitable even if consumers are forward-looking. You may think this is not a very surprising result, as indeed you would expect that if firm B has this advanced capability of using data for future pricing, it would be better off by using it. But this is at odds with some other papers in the literature that have found that the opposite thing may happen. In our paper, we find that firm B has no incentive to self-regulate its use of data tracking. Now, I think the more interesting case is firm A. When comparing firm A's profit in the three settings, first, we find that it's always better off with no data tracking. So it's always better off when the playing field is leveled and there is no data collection that is driving prices down. However, when we compare the settings with forward-looking or myopic consumers, we see in the picture here that no setting always dominates. So what is going on here? We have the two trade-offs, two effects that are going in opposite direction. On one hand, we have what we call the privacy effect, where due to consumers, when consumers are forward-looking, firm A can charge them a higher price for product 1, because firm A understands that it's not only selling product 1 to consumers, it's selling product 1 plus the added value of preserving their type or preserving their privacy from firm B. And consumers may be willing to pay slightly higher prices for that. On the other hand, we have a competition effect. When consumers are forward-looking, firm B must offer a larger discount to induce consumers to buy from it, because forward-looking consumers understand the value of their information and factor into their trade-off computations. And due to these lower prices, firm A is also forced by competition to lower prices, which reduces profits. Which trade-off dominates? It depends on the parameters of the model, but as we can see, the trade-offs can go either way. Okay, let me conclude. The main message of our talk is that when thinking about privacy protection in data tracking, in markets where we have these data tracking structures, it's important to consider two factors: the competitive structure of the market and the degree of consumers' understanding of how their data may be used in the future. We found that regulation that removes data tracking could in fact reduce consumer surplus, even if consumers act myopically. However, for this outcome to occur, it is necessary that we have competition in the market. And finally, when we think about mergers, it's important to consider the synergy that arises between markets due to data tracking. The implications of tracking may not be confined within a single product market where the data is used, in this case, the market for product 2, but also has consequences in the market for product 1, where a competing firm that is not involved in collecting data may also be affected by mergers. This is the end of my talk. Thank you very much for your attention.